So somebody asked me about, on YouTube, about finance. Can you recommend a YouTuber that is similar to you but provides guidance and motivations in finance, investment, banking, and securities industry? I can't recommend anybody in particular, but what I'll tell you is some of the things I have done and I've seen. So up until about 7 years ago, for a period of about 4 years, I was almost full-time doing all this kind of stuff, investing and stuff. And I'm not a professional. I just took a whack at cash and started playing in the markets and so on. And what I'll tell you is this. Here are my top rules of investment through hard-earned experience. I came out, now I'm a passive investor, which I think most people should do. 99.99% of people should do. And I'll get into that in a second. But I was actively buying securities, selling them. I was in commodities. I was in equities. I was playing with ETFs and playing derivatives through the ETFs, et cetera, et cetera, et cetera. So all of a said and done, let me give you some blanket statements about investing that I've discovered. Now, remember, I am a software developer entrepreneur, so, and legally speaking, I can't give advice in terms of stocks and so on. So keep that in mind, caveat emptor with all this. But you'll see that my opinion is actually an opinion of safety. So I'm data-driven. Meaning I look at the stats and I make my decisions based on that. And one of the big stats that is very interesting to me is that the broad market, basically if you bought an index fund, if you don't know, is just basically a slice of all the top companies in the Dow Jones, as an example, or the NASDAQ, etc. So basically you get a little piece of Apple, a little piece of Microsoft, a little piece of Oracle, a little piece of ExxonMobil, you know what I mean? You get the idea. A little piece of McDonald's. So you buy that, and what it is, this fund basically tries to capture, and they do a good job, the flow of the general market, as opposed to trying to pick individual stocks, hoping you can get that home run. Here's the stat. The best traders in the world, the guys and girls who work at Goldman Sachs and JP Morgan and all the other major banks and all the hedge fund guys, they will 90% of the time, 90% of the time, underperform the broad market. So what does that mean? You get these guys and girls who are studying it, trading in and out, reading reports, trying to figure out all the angles, their full-time job, and they went to school for years to study all this stuff. There's an 80-90% chance that they will do worse, and significantly worse, than if you just bought an index fund, which is just like a slice of the top companies. And let me give you a concrete example. It's kind of famous. The most famous and possibly the most successful investor of all time, Warren Buffett, third or fourth richest man in the world. He bet 8 years ago, the hedge fund industry, that if he bought the index and just took the dividend profits from those every year, reinvested, he said he would outperform any hedge fund. And 8 years going, one or two of these, a certain number of these hedge funds took him up on this anyway. So going forward, I think it's 8 years now, the hedge funds are up like 200%, not bad. Whereas Warren Buffett, who did nothing, is up 800%. So I don't know about you. I'd rather be the guy or the girl who does nothing and is up 800% versus trying to figure out the angles and all this kind of garbage and be up only 200%. Wall Street, there's a lot of scamming with all this kind of stuff. You see, the banks, they want you to trade in and out, buy stock, sell stock, buy stock, sell stock, because they want transactions. That's how they make their money. They want, every time you buy and sell, they make money. So they want you to buy and sell. So they say you should buy and sell. No, you buy, you hold, you forget about it. But better than that, you just buy an index fund and you forget about it, because it will outperform. Now, if you want to confirm my thesis, I'll give you an example. I looked at Apple stock, and you just go to Google Finance, you type in Apple symbol, just type in Apple, or I think it's AAPL is the symbol, or APPL, one or the other. And then you can click a little button, you can click 5-year, little blue link, and it will show you the chart over 5 years. And you see that Apple in 5 years, its stock has gone up like 78%, something like that, which is great. Apple, the biggest, richest company in the world. But if you type in S&P 500, right, or Vanguard fund, right, that tracks the S&P, and you do the same, click the 5-year, you see that it's up just about the same. It's maybe 0.5% off or something. So if you picked Apple and you're lucky that you picked the best performing, well, the richest company on the market today, you'd be up 78%, and you pick the index, you'd be up 77.5%, something like that. You see what I'm saying with this? Now, you say, well, why don't you just buy Apple? Well, because Apple is performing well now, but who knows what will happen 2 years from now. But there's one thing about the broad market. The broad market goes up or down, but at the end of the day, by just buying an index fund like that, you don't have to think about it. You're going to get all the good stuff. You're going to get the bad. Yes, some of the companies in the index will go down, but you're also going to get some of these killer winners, and it all kind of balances out. But again, the numbers show that over like 10 or 20-year period, something like that, if you just buy the broad market, the index funds, you're going to outperform most of these traders. You get the occasional unicorn. Most of the time, these unicorns will have a streak of luck for 4 or 5 years, and then they're failing. And they fail like crazy. There are some exceptions, like Warren Buffett. But Buffett, he's got access to all his insider information stuff because he's sold. And then when he buys, he just holds for many years, typically. He'll sell it here and there and so forth, but many years. And I'll just add this. Warren Buffett said that when he dies, and you imagine this guy's going to die fairly soon, he's getting old, he said for his wife, this, in the will, index fund. That should tell you everything, right? He's got all the best people surrounding him, so now just have them buy the index fund. That's the safest way to go. So that is my suggestion with regards to the market. The other thing I want to point out is that another thing that they mention, but it should be really emphasized. You should have extreme diversification with regards to your investments, because you never know what's going to happen. So that means across many companies, or the index funds, maybe different sectors. Maybe you have for the U.S., maybe buy an index fund for Asian markets, and have some bonds as well, because you never know what's going to happen. So you don't want to be trying to be on top of these things and track these things. History shows, the numbers show, if you just buy the market and you forget about it and you wake up 20 years later, you're going to be way up and outperforming most people. The market always does better than housing, always does better than any other market segment. And there's ups and downs and everything, but trust me, if you actually look at the math, you may have bought a house 7 years ago and you're up 200% on the house, but if you bought the stock market and you just bought the index, you're up 800%, right? The other thing is the emotions play a huge role, and that was my mistake in the past. Like, if I hadn't been so concentrated in positions, meaning put too much money into a particular investment, I would have done much better off, because when you got too much money in a particular investment, you get very nervous and you start selling because you get nervous if it goes down, then you miss the upsides. Whereas you spread it all out so you're not emotionally invested in a particular investment, it's much easier. First of all, you sleep well at night, and second of all, you're able to let it just ride, because stocks never go up in a straight line. They're going to go up, and then they go down, and then they go back higher. So what I used to do, I remember I was trading silver, and I did very well with silver, but I would have done like 4 or 5 times better if I hadn't had too much money concentrated in my silver investments. And I remember silver would go up, and then I figured it was going to go to here, and I had bought here. And it went up, and then it would start to go down. But because I had too much money in there, I was getting nervous. Oh my God, it's going down. I better sell. So then I would sell, and it would continue to go down a little bit. And I go, all right, I'm cool. And then it would shoot back up past where I sold it. I'm like, oh, I just missed 2-3%. And I jumped back in, and I kept doing this because I was too heavily concentrated. So I wasn't able to emotionally stand the ups and the downs when you have big money in it. But if I had put just my rule, no more than 5% of your investing money in a particular investment. So if you're buying silver, no more than 5% of the cash that you have for investing in silver, let's forget about it. If you're buying, if you want to buy individual stock, which I wouldn't do, well, I won't get into it now, but you want to put no more than 5% into that, and you forget about it, et cetera, et cetera. This way, the 5% rule means that you sleep well at night. Because if you buy, let's say for instance, you buy Apple stock. just for the sake of argument, and a year from now it's gone down 10%, right? But since it's only 5% of your money, you're only down 10% of 5% of your money. That means you're only down 0.5% of your entire cash. So you're like, meh, I can handle 0.5%. But imagine if you would have put 50% of your money or 40% of your money or 30% of your money into Apple and it goes down 10%. Now you're down 4%, you're down 5%, you're down a lot. You get the idea. And that makes you nervous, and that makes it difficult for you to play the long-term play with Apple. Now, Apple itself, I invested in that, did very well. I bought it when it was in the $60 range, and I sold it like $140 or something, and I thought I was the champ. But it's since gone up quite a bit, right? Again, I was highly concentrated in that, and that's why I said, I'll take my money and run. But if I would have just put a position, just held it for, as Warren Buffett advises, forever, for 10 years or so, I'd be way up in terms of Apple, and that's one example. But Apple, the most powerful, the most richest company in the world, even its stock went up to, was that 50 and 60 and 70, it went to 140, and it went down to 70. Apple went down to 70 during the crash, and then, so nothing goes like this. You usually, so if you're too highly concentrated, you're too emotionally involved, you won't be able to play it out. So keep that in mind. Again, I'm not an investment counselor. These are just my personal experiences. I say, play to the numbers, and the numbers tell you that you're much better off just buying an index fund and getting on with your work, and you do much better. And so by buying an index fund, you're heavily diversified, and what you do is you buy over time, so you're diversified over time. So diversification is the key to all this long term. So especially if you're young, if you're in your 30s or 20s, dude, just take your time. You'll be fine. Just buy an index. As far as I can tell, the Vanguard is the best, because a lot of these funds have all these crazy fees, and they'll eat so much of your profits in the fees. Vanguard has the rock bottom fees, so I think that might be the best way to go. But again, you got to research this yourself, because I'm not an expert in finance. But I have some battle scars, so you can learn from my mistakes. Ciao.